enable. Ashika Investors Meet.
Good evening, ladies and gentlemen, and welcome to Ashika Investors Meet. The core agenda of the convention, Proxy for Future, as the name suggests, is to bring together the experts of the economy, veteran speakers of the market, and growing corporate to exchange knowledge here. The Ashika Group is one of the fastest growing investment banking, securities and investment management firms, providing a range of financial products and services to a wide and diverse clientele across India. At Ashika, we believe leadership is not about the next election, it's about the next generation. To take the legacy forward, can we please have Mr. Chirag Jain, who is the CEO, Investment Banking, and Mrs. Ishita Jain, AVP, Institutional Equities, on stage to say a few words about the group.
Most of you know us as brokers, or even just as a financial services firm. But we are more than that. Given that Ashika Group has been built on the strong fundamentals of our expertise in various services in the field of finance, but we are beyond that. Let us take you through the entire universe of Ashika Group.
In our business universe, we have 7 verticals. Starting with broking, we are SEBI-registered trading member of NSE and BSE. Our broking business has 3 subdivisions that cater to specific needs. Our stock broking business rendered a whopping turnover of 22,000 crores in the cash segment only. Thank you. Cornerstone of our broking business, rather any broking business, is their research department. We have built a robust research that produces our highly regarded products, such as our crown jewel, our monthly magazine, Insight. I'm very happy to tell you that 3 out of every 4 recommendations that we made in Insight have hit the target. In our retail broking arm, we are proud to inform you that we reached 1 lakh clients via a pan-India network of more than 450 sub-brokers and authorized persons. We were awarded Best Performing Retail Member in the Eastern region by National Stock Exchange. Keeping up with the pace of technology, we very recently launched a mobile application, Ashika Infinity app.
Moving on, our second vertical is where Ashika started, our investment banking business. We are a Category 1 merchant banker and in a very short span of time have raised over 10 billion rupees. In the next 5 years, Ashika Capital's mission is to target at least 2 out of every 10 transactions in the consumer space.
Our third vertical is our lending business. As an RBI-registered NBFC, we have a book size of 160 crores. Ashika Credit Capital is also listed on MSCI and CSE. As for vision of Ashika Credit Capital, we are working to grow our book and envisage reaching 300 crores this year and 700 crores next year. We are also eyeing listing on NSE and BSE in the near future.
We have very recently set up our wealth advisory platform for comprehensive and tailor-made solutions to our clientele. At Ashika Wealth Advisors, our motto is to have an advisory approach and not a sales approach. We are so pumped with this great kickstart to our one-of-a-kind event in Calcutta. We once again welcome all of you to AIM Ashika Investors Meet. Hope you continue to be our family and continue to grow, because only if you grow, we grow.
Thank you.
Now we are here to launch the book titled Derivatives. The book provides a concise, accessible treatment of the subject of derivatives. It describes various instruments, their use and pricing, and the functioning of derivative markets. The book will be useful for the investors, traders, bankers, policymakers, and also for academics. Through this platform, it is our endeavor to bring you the thought leaders and experts of the economy. To begin with, can we please have our chief guest for the evening, Mr. Sanjeev Sanyal, Principal Advisor, Ministry of Finance, on stage. I would also like to call upon the authors of the book, Mr. Anand Nageswaram, adjunct faculty professor, SMU, a well-known Mint columnist. Mr. Harsh Gupta, CIO, Ashika Group. We would also like to call upon stage Mr. Gopal Agarwal, Senior Fund Manager and Head of Macro Strategy, DSP BlackRock. Now let's launch the much-awaited book. For that, I would request Mr. Sanjeev Sanyal to do the honors, please.
Ashika Investors Meet.
Now I would like to call upon stage Surbhi Upadhyay from our CNBC TV18 team for a chat with Mr. Sanjeev Sanyal.
Let me start by asking you this. It's been almost 4 years. Government has been in power. Came with a lot of promise and obviously a lot of legacy issues as well. We've gone through our own motions. Now the RBI tells us that we're probably looking at 7.4% growth for the current financial year. Does it feel like 7.4% to you? Does this feel like Achhe Din? Where do you think we are?
Difficult to know. I don't know what 7.4 is supposed to feel like. But the economy is definitely growing very fast, and there's no doubt that it is now the fastest growing economy of any size in the world. And that is definitely true. It's not just our opinion. This is something, as you said, the RBI put together, and we very often don't agree on things, but at least on this one we do. But also the IMF and, all the indicators clearly show that we are growing very, very fast. And in fact, we went past France last year, and now we have gone past the UK, and we are now the 5th largest economy in the world in US dollar terms. So, and by the way, this is after 170 years that we have an economy bigger than that of Britain. So finally, after all those years, we finally have managed to sort of throw off the impact of colonization, which we had. So yes, we are now the 5th largest economy and the fastest growing. So watch out, number 4. We are coming for you.
Okay. Well, definitely something to celebrate for sure. And I do want to talk about the big picture with you. But before that, let me play devil's advocate, because that's what we do here in the media, right? So the numbers look good, 7%. And even if you're looking at corporate earnings, things seem to be picking up. Whether you're looking at auto sales or you're looking at indicators like aviation, just the number of people flying, those numbers are looking good. But at the same time, the one sort of niggling issue that everybody points out is, are the animal spirits actually even beginning to ignite? The private sector participation that we are waiting for, CapEx. If you just go by data, and I was looking at some data because I was meeting a big economist, right? So if you look at, for instance, CMI's numbers, and they talk about how in the first quarter of this year, new investment or new project launches are down by 22%, and CapEx, private sector CapEx, is not showing signs of revival. How would you look at some of these issues that people raise across the board?
I think there are more than adequate signs that CapEx cycle is picking up, not just anecdotally, but we can see the credit growth is back in well into double digits. We can see capital goods production is up. But most importantly, irrespective of what is happening already, the fact of the matter is every indicator suggests that capacity utilization is dramatically going up. So if capacity utilization is going up, that is almost always universally around the world a sign that capacity creation will now begin to pick up. Our problem really is to make sure there's enough capital available for doing this, because we do have a problem with our banking system, which we are cleaning up, and it's still in process. So the problem is not with people wanting to add capacity. The problem now is, can our financial system deliver it? Now, the capital markets for the very large corporates will probably provide the capital. The large companies can go abroad and so on. But the real issue here is, can SMEs get the resources to add capital? And that is the real concern. So far the concern was there's too much capacity, nobody wants to add capacity. Now the concern is, can we make sure there's enough capital being pumped through, particularly to the SME sector, so that they can go out and expand?
You absolutely hit the nail on the head. Before I talk about the big elephant in the room, and that's what's happening to our banks, let's start with the biggest bank of them all, the central bank. As you mentioned, bank credit is just beginning to pick up. I think numbers are just under, 11%, the last printed numbers that we got, the monthly numbers. At a time like this, now obviously the RBI has chosen to go ahead and hike rates. Could that act as some kind of a bit of a speed breaker?
As far as the latest reading of the RBI, which just came out 3 or 4 days ago, this is what they expect, which is that the economy this year will grow, this financial year will grow somewhere around about the 7.3 to 7.5 range, which, as I said, make us the fastest growing economy in the world. And they expect inflation has broadly peaked. It's about 5% now, but they expect it for the rest of the year to average about 4.8, so a little bit below where it is. I would count that those very, very good numbers because, frankly, we not only are going to see high growth, but for once, it has nothing to do with pump priming in any way. Our fiscal side is very well contained. As you know, we have kept it very tight for several years now. And on our monetary side, we in fact, we have argued often whether it's too tight, and they have tightened it a little bit more. So it is not the case that we are getting growth because we have gone out there irresponsibly, expanding either on the fiscal or the monetary side. It is the case that things have been kept very tight, and we are still generating this kind of growth. So it is very high quality growth. And this is happening at a time where we have also simultaneously carried out several painful reforms over the last 24 months, whether it is cleaning up of the banks, which had been a mess for quite some time and everybody grumbled about it. But ultimately, we did begin to clean it up. We introduced GST, again, a reform that was debated since when I was at university. But after 20 years, finally, this government decided that let's do it. And yes, when we introduced it, we were not 100% sure exactly what the unintended consequences of it would be. So, people say, oh, we should have prepared more. But the fact is, we debated it for 20 years. The only way to do it was to do it. And that's what happened. We were fully aware that, there would be glitches. And so we took feedback, we fixed those glitches. And 1 year on, I can reasonably say that we have a GST that functions and is a radical improvement on what we used to have.
Economists will worry about populist measures as we get into the last year of the government's present tenure. Is that something that, your thoughts on that subject? And again, to turn that around into opportunities, we started by talking about reforms. What else do you think can be achieved before we actually head into the general elections? The
government has hardly been populist at any point in time. We, in fact, created a monetary policy committee framework, which in fact ties down any such thing on the monetary side. So that is completely independent, as you know. In fact, they have just tightened, if anything. The
post of the chief economic advisor is open. Is that a job you'd be willing to take if it were to be offered to you? Clearly, it's not something I can comment on television about. Thank you very much for your time, and thanks for taking all the questions. Thanks to the audience.
Ashika Investors Meet.
Now moving on, it's time for our panel discussion. And the topic for panel discussion is investing in the idea called India, which brings forth the perspective of the financial leaders. And in no particular order, I would like to invite our esteemed panelists, Mr. Gopal Agarwal and Dr. Anand Nageshwaran on stage, and Surbi Upadhyay from CNBC TV18.
Well, we have Dr. Nageshwaran as well as Gopal with me on the panel. So let's get started. Gentlemen, straight away, we're speaking at a time when the sentiment, at least in the market, in terms of the equity market, seems to be good. Indices back to their historic high levels. But there are lots of questions as well. So, Dr. Nageshwaran, opening thoughts, not that the equity market is the best barometer of how the country is doing, but just looking at the last 6 months of consolidation, right from budget day onwards, and now this resurgence back to all-time highs, how do you view the equity market in India at the moment?
Yeah, I think when you say the market sentiment is pretty good, that's usually not the good time for investors, because the best time to invest is when the sentiment is quite depressed. So as an investor, you should be looking at when would the sentiment get depressed and the prices get cheaper enough for me to go in. So if you look at it from that point of view, I think what I'm going to say would actually should be seen as an optimistic statement, which is that the global markets and of course by extension the Indian market are in rich valuation territory, and therefore the risk of a pullback, whether it is short or meaningful, is pretty high. And therefore investors are basically should interpret what is coming next as a potential, the big sale opportunity when you go and buy things. So that is the way I look at the current state of the Indian market and the global market.
Gopal, you've been managing money for many, many years now. The one complaint, justified complaint perhaps, that we've had with the move over the last 1-2 months is that this is a rally that's been led by a handful of 6 or 7 stocks. And they're high pedigree stocks. I mean, they're the no-brainer stocks, really. Whereas the mid-cap market went through its own motions. And we saw a big shakedown. We had issues with respect to balance sheet problems. We had auditors resigning, investors not knowing what's happening. There was a serious confidence shakedown in the mid-cap side of the market. Is that over, or is that still a question mark?
See, generally in the marketplace, what happens in the rising interest rate scenario, generally the mid-cap underperforms massively. And what we had seen, like after the demonetization, the bond yield went to 6.14, and then we have seen it has shot up to 8%. So in generally rising interest rate scenario, mid-cap tends to underperform, and that is what we have witnessed in the marketplace. Similarly, I would say that the high pedigree companies have done well, because what we have seen the re-emergence of growth into the businesses where they have put in capital for the last 3-4 years, and now which the project has fructified, and you have seen the big earning delta. Okay. Similar trend, what I can tell you that in mid-cap companies, certainly in some of the companies we have seen the balance sheet issues or the auditor issues, but it is always a part and parcel of the game. But generally, I can tell you that we should not worry about this kind of shakeout in the marketplace, and it generally happens with the interest rate cycle. If you plot back, like the bottom of the mid-cap formed after the July 13 rate hike done by Dr. Subba Rao, and after October, the mid-cap actually bottomed, and we have seen 5 years of great rally. And then again, we have seen a rise in interest rate, and again we have seen the mid-cap underperform. So our sense is that as the inflation in our view is more or less we have reached to the peak, okay, and the way the government has done well in terms of GST revenue collection and everything, my sense is that the fiscal is almost under control. So gradually you will see the worst of the interest rate fear will get over, and mid-cap will slowly, with some kind of volatility, will continue to do well over a period of time.
Okay. Dr. Nageswaran, take off on that point, if you will, please. The market did digest rate hikes very well, and we've seen two hikes in succession. It didn't seem to deter the bulls too much. In fact, we've seen even some of the rate-sensitive stocks move higher. So how do you read the different parts of the puzzle?
Well, I think I share the bewilderment or puzzlement that is implicit in your question, that the market has handled the rate hikes, and why the US market too has handled the rate hikes well, the trade disputes, everything. So I think that usually is the danger, because we need to accept the fact that globally the cycle is in its 10th year now. I mean, the US economy bottomed out in June 2009, and the stock market rally began in February 2009. So it has been a very long I would call it unbroken spell reasonably, and therefore one should be worried the longer it lasts, because never are we going to go through a phase without any correction. I mean, that's a given.
Now, when it comes to creating portfolios, given where we are, given some of the risks that Dr. Nageswaran highlighted, what is your approach at the moment?
See, I can tell you, I beg to differ on few points. I strongly believe that the world equity market, especially emerging markets, are trading very cheap. Okay. If you look at even in the context of the nearby region, like we are seeing in Hong Kong itself, the earning growth of 9%, and market has corrected by more than 10%, right? If you look at the PE multiples across Asia has come to 10 to 12 PE multiple. In our case also, we are trading at 23 times. So my sense is that the market is not very pricey, right? And what happened in the past time, you had a huge growth of 5% plus. Now we are seeing the world with a 3.7 to 3.9% GDP growth, which is not very high. So there is no heating up in economy. There is no super hyperinflation in the world. So this is an ideal situation for equities.
Thank you very much, gentlemen. Thank you.
Ashika Investors Meet. Focus. Ideate. Innovate. Enable.